Yeah, good morning in Germany and Europe. Good afternoon in Asia and China. Very happy to have you to our next webinar of the Sino-German Center here at Frankfurt School of Finance and Management. As always, I'm here together with my colleague, Professor Rüdiger von Rosen. As you all know, our topic today is to discuss the economic and business consequences of the so-called two sessions meeting. Most of you will know what does it mean, two sessions. The double meeting, let's say, of the Chinese National People Congress and the Chinese People's Political Consultative Conference. I think already today is the last day of the meeting. Perhaps you know the most important result. We have the speech of the Premier Li Qiang very much at the beginning, and he announced, let's say, the goals of the economic goals of China for this year. The growth rate again of 5%, then a positive inflation rate, a moderate deficit ratio. Also, China wants to create more urban jobs. And perhaps also important for business, also for foreign business, is the announcement that, or the confirmation again, that China is very much open for foreign business and foreign investors. Plus also there is obviously some law underway to support the private economy in China. Let's say these are the, let's say in very bold terms, what's going on. You all know the situation, economic situation domestically in China is not so easy, and of course also the global economy is not in a really good shape. Having said that, we have two distinguished guests, Professor Shenglin Ben, as the Dean of the Zhejiang University International Business School. And we have Jens Hildebrandt here as a delegate and chief representative and managing director of the German Chamber of Commerce in North China. So, of course, they are very much familiar with the business and the Chinese economy. The procedure, as always, we have two introduction statements. We're starting with Professor Ben of around 15 minutes or so, and then we have Jens Hildebrandt for his introduction statement. Then we have the Q&A session, so please, you can post your questions for the webinar here, and we can forward it to our speakers. We will record the introductory statement, but not the Q&A session, so feel free for your questions. Yeah, having said that, I hand over to my colleague, Rüdiger von Rosen, and he will give some more information about the speaker and then hand over to the speaker. So Rüdiger, the floor is yours.
Welcome from my side as well. Professor Ben is a decade-old friend of the Sino-German Center in Frankfurt. We have seen him many, many times, and we are looking forward for at least as much meetings in the future. He is Dean of Zhejiang University and president of the Beijing Frontier Institute of Regulation and Supervision Technology. Prior to that, he worked 20 years in China and abroad with ABN AMRO and HSBC and JP Morgan Chase, etc., etc. So he is the expert, and of course, his opinion is much more interesting than my introduction. So, Shenglin, Professor Ben, the floor is yours.
Thank you, Rüdiger, and good morning to all of you in Europe. And I have been asked to talk about the future of Chinese economy, and of course, it would take probably 3 days to talk about this big topic. I will use a few keywords to talk about the Chinese economy. First and foremost is the challenges. Let's see. Challenges. There are a lot of challenges, geopolitical challenges. In Europe, you are talking about de-risking. In many other parts of the world, they were talking about decoupling and so on and so forth from the global supply chain, which China is a very important part of. And of course, there are technology challenges and like AIs, which are creating a lot of challenges for Chinese economy, the data, privacy, data sharing, how to make sure that they do the good things for the society. And of course, in China also, we are entering the aging society. So which is something new to China and not unfamiliar to to Europe and say Japan and other countries. So that's a social challenges. But also there are a few other sectors which are struggling, especially the real estate sector. You have heard from many parts of the world, especially in media, about say like a country garden and other things, and even some of the banking and local government debt, which are a serious challenge for the Chinese economy. But let us also remember that China was growing at 5.2% last year, and this year we're talking about 5%. So for a major economy like China, this kind of rate of growth is slower than the previous numbers, but it's still among the highest in the world, especially in the major economies. And secondly, like the CPIs is actually very much manageable. The budget deficit at the country level is about 3%, which is also very much manageable. So there's a lot of capacity to do more things if they choose to. And talking about unemployment rate, the official urban unemployment rate in China, especially in the cities, it's about 5.5%. Not too bad. It could have been better. And each year, China needs to create about 12 million new jobs for people who are entering job market, especially like university graduates. So these are the size and the scale of the Chinese economy. And to that extent, that also tells that China is more than a country. It's, I was talking to Jens earlier that, different parts of the country, they are so different in many ways. We're more like personally like continent in terms of size, in terms of the scale, and in terms of scope, for example. In different regions of China, I'm from Zhejiang, which is the Yangtze River Delta region, where the entrepreneurship, innovation, private sector are thriving in many ways. For example, in Zhejiang, we were growing about 6% last year. For economy of about over 1 trillion euro size. So for Zhejiang alone, as a state, as a province. And in terms of sectors, certain sectors are not doing too well, as I mentioned earlier, like for example, real estate, if you're in certain other sectors. But there are also other sectors which are very busy. For example, electric vehicles, and even for pharmaceutical healthcare, the people who are doing like a traditional Chinese medicine, they seem to be doing very well. And the latest is about the export. If you are in exporting sector, despite the challenges like de-risking, decoupling, whatever, if you are exporting to Southeast Asia, for example, to Vietnam, to Malaysia, to Indonesia, or Mexico, you are doing very well. While if you are focusing only on the European market or the American market, maybe more challenging. So that means the global supply chain is having an unequal impact on the Chinese economy in terms of different sectors, different industries, or different regions. But the challenge that we are facing is actually unprecedented, I would say. China is in a serious and important transition after over 40 years of uninterrupted growth since 1978. So I see a few trends that we are experiencing. First and foremost, we were relying a lot more on the inbound investments, FDIs, foreign direct investment into China, especially like German companies, for example. But increasingly, we are doing a lot more outbound for various reasons. So that means the Chinese economy, a lot of activities will be not just domestically in China, onshore, but they are doing it offshore, in Indonesia, in Thailand, in Mexico, or in Middle East, and so on and so forth. So that means the economy will be shifting a little bit away from the GDP, which is more domestic, to a GNP, which would be like a globally accounted Chinese economy. Secondly, the trend is what I see is that Chinese companies start becoming a leader instead of just a pure follower. That means at one point, China was copying a lot of business models from the US, from Europe. So that's what we call copy to China. It's easy. Today, we need to be leader, to innovate. So that means people say increasingly, there are a lot of opportunities for people to copy from China. That means China is contributing to the global innovation in terms of technology, in terms of business sector, and many other things as well. And third trend, what I see, is that, because the aging, see, China was relying on the so-called demographic dividend. That means rely on the increasing population. But today, we are going to probably rely a lot more on the so-called talent dividend. That means the higher value, contributions by the people, the higher growth, higher quality growth. Okay, so that means as China is moving along the so-called higher the so-called like value chain, and that means technology innovation will become key to us. And so overall, China will be focusing a lot more on the higher quality growth. Then it would include like ESGs. So you would be surprised. So many companies are talking about ESGs. Europe is the leader in that area, but China is catching up in many ways. So environmental, social, and governance. So these are actually very encouraging things. Okay. So in short, the challenge is China is in a period of transition. We are transforming our economy. And the transformation period in any country is going to be difficult. And I think it is same for China. It's difficult. It can be even painful. And for many general public, there are some anxiety. For entrepreneurs, they're anxious as well, because the era of easy money, more comfortable, anything that goes is over. So we just need to be a lot more, balanced in terms of our own perspectives about it. So that's my first keyword, like so-called challenges, and very much unprecedented challenges. The second keyword I have is that confidence. I think given, the anxiety people feel, so there is a lack of confidence, or at least it's not enough. Let me reflect in the consumer side. Consumers are not spending as much as they should. So that's why many people say, oh, China should actually encourage consumers to spend. But they are worried about the outlook sometimes. They are worried about the retirement and many other things as well. So the consumer sentiment needs to improve. Yeah? And secondly, of course, from the investor side as well. The investment, if you are worried, if you are concerned about the future outlook, you are a little more hesitant. But there are also good things, as the recent prime minister at the 2 sessions where people were talking about how to improve the business environment so that the entrepreneurs would be given more assurances about what is the more predictable environment going forward. More importantly, the investment cost, the cost of investment right now is lower in China. For example, because the interest rate is lower, because of the slowdown, when you want to do something, it's a lot cheaper. If you want to buy into a company, the valuation of the company is more reasonable. So I think this is also, in essence, like giving them the hope and the confidence. And thirdly, the export side. I mean, you probably have already noticed in January and February, despite all the challenges, despite all the talk about the risking, offshoring, nearshoring, whatever, China's export grew by 7% year on year this year, which is, I think I saw the New York Times, the headline news say, oh, China is growing 7%. It's going to invite additional anxiety among, people in Europe or other places. So to that extent, what I see is that from a consumer side, from the investor side, from export side, and from the manufacturing side, I see China, despite the slump, despite some of the slowdown, I think we should be okay. I'm carefully and cautiously optimistic about the outlook. And I think the international media should really get yourself updated about what's going on in China. So you should come and visit us. And I was in Shanghai over the last 2 weeks, over the weekend. I can feel the consumer sentiment is recovering. I can see more foreign visitors, foreign tourists in China as well, in Shanghai. So which is great. And because it's important, China is a difficult market to understand. I would say, given the complexity, given the size of the country, even as a native Chinese, frankly speaking, I don't really understand China sometimes. I wasn't able to predict how China was able to grow, for example, over the last 40 years. I wasn't. So that's the second keyword, the confidence. And the third keyword is capacity, I say. My cautious optimism about Chinese economy is based on the fact that China has the capacity and the capabilities to be able to deal with the challenges we face. That means despite the fact we're not probably going to see 7, 8, 9% growth annually in the future, which shouldn't be like that because the size of the economy is already so big. 5% of the Chinese economy each year is already significant. It's about one of the top 20 economies in the world if on an annual growth. So that means it's 5% growth. I think it's good. What is important is really the quality of the growth, I think, which is more important. And I believe the Chinese economy can handle that based on the following. First of all, I think, the manufacturing side, China probably has one of the most comprehensive manufacturing, so-called like industries and capacity, the supply chains, which is not going to be easy to be so-called like, disrupted in essence. And China has one of the largest markets to test some of the new products and to prove that they can do that. And of course, China has some of the probably best infrastructures in terms of logistics, supply chains. You look at the highways, the high-speed trains, all these things, the infrastructure side. And of course, increasingly, China is focusing a lot more on the technology innovation. For technology, for talent, if you look at the report from the Prime Minister, I think at least 20 times they talk about talent, I think, which is important. And of course, China also has the financial capacity to deal with the challenge because, as I said, the budget deficit is 3%. It's manageable. And Chinese in general are saving a lot in many ways. So in essence, there's a financial capacity to deal with some of the slowdown. And more importantly, I think what is critical is that our financial system needs to be more efficient. We need to make sure that the savings, can be, dispersed to the right sectors, right companies. And also, finally, the most recent, 2 sessions also had a so-called organization regulation for the State Council. How State Council, which is the cabinet for the economic matters, how they are going to organize themselves. So for the first time in many years, they have updated how the State Council should be organized. So that would hopefully improve the efficiency and also focus the State Council's job on economic matters a lot more sharply. So that means the governance side, the political structure of the Chinese government and economy is probably a lot more synchronized in many ways going forward. And so to that extent, I think they have the capacity to that. So my 3 keywords, challenges, confidence, and capacity. And in concluding, to answer the question about the future of Chinese economy, I would say, first and foremost, yes, Chinese economy will probably grow slower than before, but it will still be pretty high, pretty significant growth rate. And the quality of the growth will be higher. There will be a lot more focus on sustainability, environmental, and so on and so forth. And secondly, the Chinese public, Chinese entrepreneurs and the businesses would have a more stable expectations about the future because they were used to the 9% growth a year. They were used to the easy money period of time. Their expectations are being readjusted. So that means they will recalibrate their expectations and hopefully they will, have the right, approach to their future consumptions or, investment and so on and so forth. And finally, I will say with those, I think the Chinese economy would be a bit more sustainable. Okay, 9% of growth each year for China is not sustainable. It's not necessarily required either. So I think a more sustainable, more stable, even though slower growth rate for China I think it will be good for China and also for the world. Thank you.
Thank you, Professor Ben, for this first-hand inside view. And I must confess, I'm a bit envy on the expectations, because if we would have the same expectations on the German economy and the growth rate, which you elaborated with 5%, we would be extremely happy. There's nothing of this to see in the future. Jens Hildebrandt will talk about the challenges you mentioned for the European business world, for the European and specifically, of course, German companies. He is Chief Representative and Managing Director of the German Chamber of Commerce in North China. He is one of the German experts who even studied sinology in Leipzig, Beijing, and Hong Kong, besides political science and economic experiences. And he is an old hand with experience with Chamber of Commerces in Asia. So Jens, the floor is yours, and we are looking very much forward to your answer to challenges in China.
Thank you. Thank you for having me here today. I think that's really good that we have some input from Professor Ben, because we tend to look at things a little bit more cautiously or more negatively. But that's why I liked your presentation, because of course the glass is never half full and never half empty. It's, you know, something in between. It's never black and gray, black and white. So gray tones are very important. And that's why I wanted to pick up a little bit on what you said in terms of challenges, confidence, and capacity, maybe build on that. Because the two sessions indeed, from our point of view, have brought not many surprises. It was very much in line what we expected. However, the challenges you laid out are absolutely right. The Chinese economy has a structural issue. After 40 years of growth, this growth has come to an end, and now the question is really how to find a new growth model that drives it. And obviously the answer that was given to us at the two sessions is to say, let's develop into high quality growth, which is a target that also fits in the overall line. And I think that was the main message of the work report Li Qiang gave out, that China is about stability, reliability, innovation, and high development growth before or in front of the background of stability and security, that for sure. And the challenges you've mentioned, I mean, you mentioned the real estate sector. Surely we don't see a solution immediately to that. And the main question I'm asking myself, or a lot of people ask ourselves, what is going to be the replacer of the real estate economy? Because 25 to 30% direct or indirectly are connected to the real estate sector in China of GDP. That's a huge chunk. And you're right, foreign markets, so export has been good in January, February, but still we see volatile markets. We see Germany is not developing, maybe has a 1% growth this year. And other markets, except for the US are not, in Europe, are also not doing that well. So export is also a challenging area. So in terms of the challenges the Chinese economy is facing, the question is, as I said, where's the replacer for that? And we see what does actually the Chinese leadership mean when they talk about high quality development. In its core, it's about innovation. But it's also about self-reliance. So building up strong, innovative industries that and this has been industrial policy for many years already that can help China to have a sustainable, self-sufficient economy. That's for sure one of the goals. However, it's also about developing advanced industries. So we talk about AI, hydrogen power, about renewable energies in that field, advanced manufacturing, advanced material. These are areas, of course, where the Chinese economy wants to evolve into. The question is, how is that going to work out? And that's the second topic, because indeed consumer confidence is still sluggish. The numbers of consumer spending is far from where it was in 2019. It, yes, has improved, but also the business confidence of companies is not at the same level. So my understanding is what the Chinese government is trying now is long-term bonds to finance also the development of innovation and high-quality industries. And what does that mean? From our point of view, that means that we might see a lot of investment in upgrading. So, of course, upgrading the Chinese economy has been a goal for a long time, but now with a financial vehicle, with a bond that also regional governments can use, this might be, another focus area. The question is that is also heavily discussed in Europe. What will that do to overcapacities? We have a range of overcapacities in various industries. And of course, if you invest even more into upgrading, that means on one side that of course also Chinese companies will participate in that. So Chinese mechanical engineering, automation companies, robotic companies that might already have a certain overcapacity. And the other question is, we see in a lot of industries with overcapacities actually the need to consolidate. So consolidation, but would require that there's a political will to do so, because we in the automotive industry we see, for example, that we have many NEV brands, over 60, if I'm not wrong, or more, maybe even more, but only 2 or 3 of those are profitable. So and we know also from our past experience, local governments tend to support local champions that represent their province and their locality. So we hope that the long-term special bonds are not used to finance more of non-profitable companies, but that really flow into an upgrade of the economy into innovative, profitable companies. Coming back to it needs political will to do that. Sure, consolidation will need exactly that, and it will be hard from my point of view to do that for a lot of governments because it is very connected to a social question. So by not supporting companies and letting them bankrupt, you create, of course, more unemployment, and that this is something I think that nobody wants to take over this responsibility. And then on the other side, if we talk about confidence, consumer confidence, it is really about how to get consumer spending more done. And Li Qiang in this report put out some a one-year plan to increase consumer spending, also to for big ticket items that they would encourage transactional change of consumer products that are supported, that people might get vouchers do so. The question remains, even if those incentives are given, are the Chinese people willing to spend that money to invest in new cars, in new electronics, and so on and so forth. What we would have hoped to see at the two sessions is that, because you correctly said, Professor Ben, the growth model of the Chinese economy needs to change. It needs to move from a supply side focused economy that was heavily reliant on investment more to a demand side based society. For that, we would need actually social security programs to change. We would actually need to see more pocket in the money of more pockets, more money in the pockets of the Laobaixing, of the normal population of China, so that they have a better confidence in actually spending. Because if now the real estate market is down, you don't have your basically your only biggest investment has devaluated, then of course you would hope that on other sides you get a little bit of less burden in terms of retirement insurance or social insurance that gives you more money to spend. We didn't see that so far. We see more the focus on, as I said, high quality development that is again more focused on supply side. So it will be interesting to see how this gets balanced out. And I think on capacity, you're right. China has the financial capacities and also the administrative network to steer all of this shift. However, the local governments are indebted. Some of the provincial governments of poorer provinces really struggling. So the question is how China will manage the shift of financing within China, how this long-term financial bonds are used, what items they can use it for, as I mentioned before, should not be used to create another overcapacity. So this is a very thin line. You're right in terms of capacity, in terms of infrastructure, manufacturing industry. This is all we see that is happening or that is in place. One last word, what does that all mean to German companies? We have seen over the last 2 years a trend to localize more. Investment has been growing. Last year was record high on German foreign direct investment. We believe and also see in our numbers, most of it has been spent on localization and also as part of their overall risk management or de-risking. And but the major reason to invest in China is really competition, to stay competitive in China. So what we have seen laid out in the 2 sessions and the work report there will create some opportunities for German companies, as if we look at high quality products and development, surely German companies are well positioned to provide products and services in this regard. But it may also mean more competition, more fierce competition for German companies in each field. And we feel that German companies are preparing for that. And I think that this is my last remark. What is crucial for that now more than ever is that we have a level playing field in many areas, and the work report in the 2 sessions addressed that very clearly. It talked about public procurement, it talked about market access. However, what we really need to see is implementation now. We've seen many tiny steps the government has taken, and they're all very much welcomed. But the major topics on public procurement, market access, regulatory issues, that's if everyone is waiting for a big signal from the central government, and this signal has not been sent at the 2 sessions, unfortunately. So let's see what the future holds.